Unlike my background, that looks like I'm up against it's like I've just been arrested or something.
Exactly. Yeah. You look like, so it's like the perp photo.
All right, we're ready to roll. Let's go. Hey, so I was thinking about you today. Thanks for coming on the walk. You and I have talked about this before. Super laid back. I have no agenda. And the good news is, or the bad news, I guess, is that there's nothing happening in the world. So there's nothing to talk about. Like I don't, you and I, we might just need to say what's up and end the conversation because we're devoid of topics.
There's no shortage of things going on right now in the mortgage industry.
Well, or the world in general. I was going to ask, do you want to talk about, do you want to talk about the industry? Do you want to talk about the overall economic environment? Do you want to talk about, geopolitical happenings? Or do you want to talk about that your Browns shipped Baker Mayfield to the Carolinas, which is where I'm sitting right now?
Any and all of it, honestly. I'm ready to talk about anything. And the broader economy to me is relevant to our industry, and it's driving a lot of the interest rate related things going on in our industry. But yeah, there's no shortage of things to talk about in our industry as well. So I'm game to talk about whatever you think will be most interesting to the listeners. I'll be ready to discuss it.
Well, I'm just going to be most interesting to me, and then if people find that interesting, then we'll go from there. Hey, I get a question for you. So the Mortgage Collaborative, you guys do such a great job of creating an environment of collaboration, hence the name. That's created. I mean, look, our company, we've engaged in new partnerships thanks to TMC and the effort of your team in bringing people together. You guys do a really good job of creating a formal environment that still feels very informal. So thank you for that. We've enjoyed the relationship with TMC. I'm a little curious about you though. So how did you end up in the mortgage industry? And I mean, when you were a teenager, did you go to bed at night hoping that someday you'd run a mortgage company?
Is there anybody outside of maybe who is
It's a loaded question, Rich.
It's funny, just all the, you've been in this industry long enough time, you hear all the stories of how people have got into the industry. Mine is like a lot of other people's. I was a manager at an Outback Steakhouse, started there when I was like 16, was basically running an Outback Steakhouse at like 21. And the nights, the weekends, the holidays, all my buddies were in college and having fun, and I was missing all that. So I was making great money as a 21-year-old, did a complete career reversal, took like a 50% pay cut to just quit what I was doing at Outback, take a job at my buddy's credit union. Just as, at first a teller, 6 months in, I was like the consumer loan guy. And then one day I was there like a year. I was bored. This is back in 1996. So went to the yellow pages, literally went to banks, called like 10 or 12 local banks I knew and said, hey, can I have the fax number for your HR department? And literally just cold faxed over a resume with no cover sheet. Got a call the next day from Old Metropolitan Bank and Trust, which has subsequently been bought by Skybank, which got bought by Huntington. And yeah, they said, hey, we saw your resume come over. You want to come in for a loan processor position interview? I said, sure. Get there. I'm in the waiting room, and a guy comes out I'm still friends with. He heads cap markets for Cross Country Mortgage, Kevin Alexander. And he's like, hey, I got an opening in secondary marketing. Would you be interested in interviewing for that as well? I said, I have no idea what the hell secondary marketing is, but I'll interview for anything. Yeah. So that started my kind. So I got hired. I was like lock-in boy, for a year, learned the industry from Kevin. He left, had his somebody else come in that was really a really sharp cap markets guy. I was able to learn a lot of the industry from. And I was cap market, 4 years there, and got hired as cap markets guy for another bank. At that point, got hired by a bank to run mortgage in Northeast Ohio back in 2002. And then, made this move. God, it's been almost 8 years now. So
How do you, as you going through that process of making the conversion over to TMC, I got to imagine that was a little risky for you. Where you had made it in the industry, so to speak. The world was your oyster. I mean, there would have been a lot of opportunities from then going forward that probably were easier to do the math on. I don't know what your compensation is, and I don't really care, but I would assume that would have been a little bit easier from an economic perspective to figure out what was the motivation to do this. I mean, clearly there were fantastic people that were pulling this together. So there's probably trust in the leadership, but put me in your head during that period of time, how you go from kind of climbing the ladder towards the top to then making a bit of an interesting move.
Yeah, it was a huge risk at the time. I mean, I was working for a bank that had never laid anybody off in their 90-year history. We had grown the mortgage division from about 100 million to about $1.3 billion. I think that said, there were some things after having been there 6.5 years. It was a very small community bank, only about $1.3 billion in assets. We had built a big mortgage engine that was doing over $1 billion a year in production. And I could just see it was starting to weigh on the bank, like 35% of the loans we did were in the portfolio, and, they weren't growing the deposit base. Our loan to deposit ratio was getting a little bit out of whack. So I saw that things were going to be changing a little bit. That said, I was not desperate to leave at all. Kind of accidentally got connected with the 4 gentlemen that started the Mortgage Collaborative. At first it was kind of like, thanks, no thanks. I got 2 young kids. I'm not ready to go work for a startup. And they just kind of stayed on me. And a couple months of that. And yeah, to your point, the 4 owners are very accomplished guys. And I really believed in what they were doing and the need that it had in the industry. I really felt like it could be done right. The way I really looked at it was, hey, if this thing does not succeed, it will not be because of my lack of effort. I think at the time I was like 37. I was, a lot of fire in the belly professionally, was ready to make that move, and just kind of figured, like, if it doesn't work out, these 4 guys that started this company are really well connected. I am going to run through a brick wall for them to get this off the ground. If it doesn't work out, it's a risk. But I got to be confident I'll come on the other end okay. And and it's worked out good. So
Are you a little surprised that you're still with TMC? And I don't mean that to sound as if there's anything negative about TMC, but maybe if you put yourself back in your 37-year-old brain. And by the way, I love the comment that you made about I wasn't going to fail for lack of effort. I don't know that I've ever heard anybody else say that. It's something I actually say. We've had employees come through our company that have asked me, what's the number one piece of advice that you would give me? And that's always the answer. Don't allow any of your failures, because you're going to fail here. Like, there's going to be days where it's just not a good day, but don't fail for lack of effort. But if you go back to that 37-year-old emotion and brain that you had then, do you think that person thought you would be with TMC this long, or did you even think about it?
I did. I hoped so. I was confident in myself. I was confident in the business plan and the business model. And I knew the ownership would be supportive. That said, I was far from sure of it. I think when I looked at it at the beginning, the 3 jobs I had before this were all with Ohio-based banks, 2 in cap markets and 1 running mortgage. I was at each of the 3 for like 6.5 years. So in my head, I was thinking, like, am I one of those guys that can only do 6.5 years with one organization before I get bored? What I'm stimulated by, though, is what you do being rewarding, and I think that's what originally attracted me to mortgage as I got into it. It's a huge part of the US economy. You're putting people into homes. It's the biggest financial purchase of their life. That said, working for banks for 18 years, it felt a little less rewarding over the years. The meltdown, all the compliance, a lot of the ways that I think community banks were unfairly punished by Dodd-Frank. And so it became a little bit less fun. I was incredibly stimulated by the opportunity with TMC, even though it was daunting. I was the only employee for about a year. We had only 3 employees as recently as like 4 years ago. So it was a lot of blood, sweat, and tears to get it off the ground. And, and here I am, it's been over 7.5 years. And I have noticed I am as professionally motivated and happy as I've ever been. But that's because I think we continue to do new, exciting things. We continue to grow. We have an ownership group that really supports the long view on decisions, that leads to great culture. And that has kept me stimulated. So to long-winded answer to the question, I hoped that I still would be here 7.5 years from now. I didn't know. But it's been a fun run.
Well, I mean, I think you're a grinder at heart, and that's probably generally how grinders look at new opportunities. For those that don't know, maybe give 30-second, kind of pitch on who TMC is. We have people that check this out that are not in the mortgage industry. I've had people on the podcast that I just find are interesting leaders in other industries as well. Vast majority are financial services and mortgage banking, but give a quick rundown of TMC, the member size, things of that nature, because I also think that folks that aren't in the industry can relate. Most industries have some sort of co-ops or collaboratives that mastermind and pull together events like yours. So give the quick pitch on the TMC model.
Yeah, Mortgage Collaborative, it's been around now for 8.5 years. We're a national cooperative network of mostly small to medium-sized mortgage lenders. We have 275 lender member companies currently. It's a mix of independent mortgage banks, community banks, and credit unions that really get mortgage and want to be in the product. And we do a number of different things to help our members navigate the waters of this industry more efficiently, more profitably, more strategically, through partnerships with great companies like Model Match, through 2 large conferences we do each year that are really designed around exchange of best practices and idea sharing. We do a ton of virtual stuff. We have a data benchmarking tool that's free for our members as part of membership. We're just making tons of connections on a daily basis with lender members. Like in my email box this morning, there were 3 or 4 of them. Like, hey, we're thinking about using blah, 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 LOS, or we're thinking about using this vendor, or we're thinking about starting this business channel. Can you connect me with a couple lenders that, I could talk this through with, that have kind of been there, done that, or our current clients. So that's TMC in a nutshell. We do a bunch of other stuff, but we're looking for every creative way we can help use the whole network to help benefit the individual members.
I hate, I shouldn't say I hate. I don't like conferences. I've never liked going to conferences. I remember my first experience going to an MBA conference was, I was relatively young at the time. I was a recruiter sitting in a cubicle that was barely as big as my shoulders. And, I played the game the way I was told to play the game. I put on a suit, I had the lanyard, and I show up at the concierge desk and I try to read names and see if I could get meetings. The beauty of that event was I was like, I'm never doing this again. I'm never, ever, ever going to do it this way again. And began to make things much more personal, much more relational. What I love about the events that I go to with TMC is that I don't have to worry about any of that. It's already very relational. It's already very personal and informal, while you're also providing formal topics that are obviously very important. So we've been in this environment that's been this sort of made up market condition over the last couple of years that we've now come out of. Talk to me a little bit about maybe what's on the forefront of the minds of your members right now, some of the challenges, maybe also some of the things that they're excited about, because there's opportunity in noise. I mean, we all know that. But then maybe how you and your team have had to adjust to provide topics that are different than maybe what you were providing 18 months ago.
Yeah, absolutely. I think the way the members look at this climate, it's hard to give one answer to that question because every situation is a little bit different, right? If you're a community bank or a credit union, you're gonna offer mortgage, right? And they're less likely to add people, drop people. So it's just a different climate. And quite frankly, right now they have a big advantage because there's just more non-conventional product being done as a percentage of the pie, and the secondary market is weak for all that stuff. So banks that want to put ARMs or other earning assets on the books, on the portfolio, it's a really good climate to do that. Independent mortgage banks, it just depends, right? The big ones are, generally speaking, all trying to grow and scale. The medium ones are trying to figure out, like, where do I want to go from here? There's a lot of companies out there right now that are like, I don't know if I want to buy or sell, but I just want to be talking to people, right?
Right.
And there's some smaller independent mortgage banks, maybe older owners, that maybe they already have sold or would love to sell. We've had already 5 acquisitions this year, just fellow members acquiring other members. It's probably matches what we've seen in the 5 years before that. So I think the way that people look at the climate right now is very individual to who owns the company, right? How many owners are there? Is it a family company? But people are looking at the future, and companies that are in it to win it for the long term, it's a reset right now. They're examining every aspect of their business, less of a focus right now on like new emerging flashy technology, LOSs and POSs and all the stuff that was all their CRMs and all the stuff that was the rage for many years, and more, let's examine our business. So much is changing in the tech world. All lenders have advanced tech. It's more looking at the nuts and bolts of their business. Obviously, companies that are in it to win it, they're looking to grow too. We want to add a new channel. Everybody's trying to recruit. Everybody right now, you know that better than anybody. The recruiting climate right now is as frenetic as anything I've seen. And then, lastly, I think the way they're looking at it is what I kind of am calling like the race to differentiate. It's very tough for mortgage lenders to differentiate each other from one another right now. And it's magnified because you have very little supply, volume is down. So every realtor or builder or referral source in America, they're being reached out to a lot of different lenders that are all saying the same thing. Like, we got every product and we could close your loan in 24 days, right?
Right.
But what are true ways that you can differentiate your organization with the people that refer business? So I think that's where a lot of the focus is. For us, our focus is, we're going to continue to do things that we've done, our collab labs, our data benchmarking tool, our conferences, all the virtual stuff that we put out there, our great partnerships with companies like yours. But some of the new things that we're looking at are, I think really related to data. TMC Benchmark has been a powerful tool for us. We've got over 100 members submitting right now. What are some ways we can use that data more effectively to help our members manage their business and manage their own performance? And then 2, training, learning, education. I think we've heard from our members, like, the mortgage industry, if I want to either bring somebody into the industry that's new, or I want to upskill somebody that's young or maybe not young and has promise, there's not like a lot of good third-party providers for that stuff. So we're getting ready to launch a platform called TMC University soon, here in a few weeks, where we're going to start to offer curriculum and classes and courses for our members on all the things that they've told us are most important to them. Communication skills, sales upskilling, and it looks like a kind of mortgage banking 101 curriculum for people new to the industry are going to be the first courses out of the gate.
I love that. I've been doing what I do, although it's evolved dramatically, for 20 years. And something that I still just don't think the industry does a great job of, and I think it got exacerbated actually in the last several years when technology became such a, the sexy topic, right? Like, what are we adding to our tech stack? What are we adding that will, at least on the surface, create value for the originator, who maybe can create value in turn for the consumer or for their referral partners? there's no doubt that there's so many tech platforms on the market now that are fantastic tech platforms. I mean, you look at the platform and you can see it and touch it and feel it, and you can, and it makes sense. I see how that would create value for a consumer, a referral partner, or an originator, or all of the above. But the challenge that I've noticed, and I'm curious to get your take on this because you're so much closer to the leadership making the decisions for so many companies, is that there doesn't seem like there was the proper investment made in the leadership to support adoption and acclimation of those platforms. So now, when margins are tightening, volume is dropping, you know, companies are trying to figure out, how do I replace, and I don't think this isn't a mortgage specific topic right now. I mean, this is happening in other industries as well, but this is the game you and I are playing. How do you replace the 25% or more of the business that just went away because rates went up? And they're eliminating some of these tech platforms that they were so excited about a year ago, 2 years ago. I would argue it's not the tech. It's the inability to plug in the proper leadership to support adoption and acclimation of the tech to create the efficiencies where ultimately you would then see an ROI. I guess I'm curious to get your take on that. If you agree with me, or if you disagree with me, or what you see from your lenders and the folks that you're partnering with.
I completely agree. Completely agree. It's, you know, mortgage technology, and, you know, to your point, other industries, it's not a destination. It's an ongoing journey. It's, you're always looking at it, working on it, looking to upgrade your stack. And I think lenders are just kind of, it's a couple of things going on right now. Part of it is what you said exactly. Right? There is no shortage of leaders in the mortgage industry that are good sales and business development people, even ops and capital markets folks, but implementing next level technology and software into a company of typically non-tech people, that's a huge undertaking. And you're so right. We have seen so many of our members over the years that have underestimated. And part of it is these companies do a great job selling, right? Oh yeah, it's, you know, listen, you buy this and off, and then, you know, 3-4 months later, then there's like, I need 2 people to support this platform. Right. So there's been part of that. I think part of it is you've just the landscape right now too. You got ICE that's looking to acquire Black Knight. You got a huge amount of lenders that are on one of those 2 platforms that are like, you know what, let's just pump the brakes on this right now. We see how this all plays out. No shortage of things to work on. Going back to what I was talking about earlier, looking at the business, every line item, other ways to cut expenses. So, you know, I think that, you know, and then part of it is, I would agree with you that it's not the tech is not the biggest reason, but I think part of it is too that a lot of tech that lenders bought over the course of the last 4 or 5 years was not fully developed tech, to be honest with you. Yeah, and I think right now it's just a fatigue factor, and then you add in the fact that volume and revenue and profits are down or non-existent, and it makes it a lot easier to punt on tech decisions till 2023.
Agreed. You know, something else I think about, and you come from the community bank side, you know, maybe a little closer to credit unions, depositories versus the IMBs. You were commenting on that earlier about their position relative to not all IMBs, but some IMBs. And by the way, we've seen this before. This isn't new. I mean, this maybe the reason where we're here is new, but where we are at the moment is not new. I saw an email that went out by an unnamed depository that has a very large mortgage channel that just basically said from leadership, we told you this was coming. You know, we just last night we see Sprout making their decision, and that's not going to be the last one. But we told you this was coming. A company like ours is the only type of model to be. There is no other option. Well, you and I both know that's not true. The options are endless, and they're very individual. And if you're doing self audits, you can make a better decision about what is the right platform for you. But I think about, so let's go back to tech for a moment. And then I want to transition to something else, because I read an article that you wrote back in 2018. I kind of want to bring it back from the vault, so to speak. I would think that the credit unions, the depositories, the community banks, they can dictate process differently, maybe, than an IMB that is traditionally recruiting with an entrepreneurial mindset, right? You at the street, your branch manager, you individually as the loan officer, we have a tech stack, you decide what it is you want to use. We're not going to tell you what to use. But that wildly decreases the stickiness of the things that in time can create efficiencies. It's like you never allow it to marinate enough to see the results. Why do you think that? Well, I think I know why it is, but maybe I'd love to just get your informal take on that environment. We've got IMBs that have done such a fantastic job of growing and creating some of the leaders in our industry. I think that there's a culture about those companies that's very different than a credit union or a community bank. But the stickiness of the value proposition and the tools and resources that are available is very different because they don't mandate, or they mandate differently than maybe the credit unions and the community banks. I've got to assume that you feel like that's got to impact adoption and acclimation of these tech platforms, as an example.
Absolutely. Yeah. IMBs are much quicker to move on tech, and the adoption is typically better than inside a bank. Banks have different lines of lending, commercial lending and retail banking and trust departments. They have their own platforms, and and that's the biggest but banks and credit unions are generally more conservative than an IMB that's owned privately by one or two people. They can do whatever the hell they want. Banks have boards and C-suite and processes and all these different business lines. And yeah, so, and if you look at like the broader competitive landscape, you're right, it's a pendulum. You go back to 10 years ago, and banks, depositories were doing 70% of the lending, mortgage lending in America, led by Wells, Chase, and Citi, and a bunch of others. And they kind of post meltdown started to back away. It was a gradual process, led to IMBs are, as of last year, probably, I haven't seen specific data, but probably 70% overall market share, led by the Rockets and Loan Depots. And now it's coming back a little bit. I think I just saw first quarter market share stats that said depositories picked up 2, 3, 4%. And it's not surprising. And this industry is so cyclical. It really is. Like, I recruited when I ran lending for First Federal Lakewood, it was right after the meltdown. We had no bad loans on the books. The bank was dying for earning assets. I had the wind at my back, right? Was able to say to these LOs and IMBs, like, listen, you're closing 3 loans a month. I'm giving you construction. I'm giving you arms. I'm giving you jumbo. I'm giving you non-warrantable condos. I'm giving you buy down programs. We're doing all kinds of cool stuff in the portfolio. Just on that alone, you're going to be able to get more doors. So that is kind of what's going on right now. But that said, a lot of top salespeople at IMBs, they're very entrepreneurial people. So there's kind of a culture mismatch. So it'd be interesting to see how it all shakes out this year.
You just said something, though, that is worth maybe me commenting on a little bit, but because you said it very simply and easily, so it comes naturally for you. Clearly, you said I could go to the ones doing 3 units a month and show them how my company value proposition can help them at a minimum sustain those 3 units a month. But really, the goal is add volume, add units to what you're already doing without more work necessarily, because you have your database, you have your relationships. That's you understanding your criteria, you understanding the value proposition of your organization and the criteria of the opportunity that you can match that to. Because the flip side of that, though, Rich, I think, is the person that's still doing 24 million, 2 million a month in a difficult market at an IMB, where maybe there's a different culture, there's a different level of flexibility or the ability to be nimble, there's a different economic structure, right? Maybe you're not priced as aggressively, but your compensation's a little bit different. So your reward at the end of that loan, if you can sell it, is a little bit different. You just nailed it. That's probably not your criteria. Those aren't the people that you're going to go engage with. And it doesn't mean you don't talk to them and build a relationship with them, but if you really want to dial in and make it as efficient as possible, It's those that are doing 3 units a month that need something to help them do more business in the same amount of time. And I think that's where a lot of companies struggle, though, is they don't take the time to think about, how does my value proposition align with the criteria of the opportunities that I'm looking for, so I can focus in the places that not only make the most sense, but when I win them, I have the opportunity to retain them, versus this, like, I'm gonna fly to security of a bank, but I don't really know why I'm doing it. And then the second I realize my buddy at an IMB is making 15 more basis points than I am, I'm going to go back to the IMB again. I find it interesting you said that so comfortably, because I think a lot of your peers don't.
Yeah, no, I would agree with that. And I think that there are IMBs and deposit that have just great culture, like institutions that have been great mortgage lenders since the beginning of time, and they have great leadership and great culture, and they're great places to work, and they have very low employee attrition. But that's like the top 10%, right? There's a lot. After you take the cream off the top, it's like, I used to always tell LOs, honestly, even when I was recruiting them, like, you should really look at your career in 3 to 5 year increments, right? Because you have earning years, and you never, there's so many variables to our industry that none of us can control, right? We're not selling tennis shoes and shorts at Dick's Sporting Goods where there's patterns, or at a restaurant you're selling steaks and wine. It's our industry, and we've seen it these last 3 years. It's like the 2 biggest years in the history of the industry, and this is going to be one that is down probably 50-60% from last year, due to nothing that the mortgage industry could have predicted or controlled. So in my opinion, LOs should look at their career in more smaller segments, 2 to 5 year segments. And like, the reason for that is, honestly, right now is a great climate to be an LO at a bank. But it could change tomorrow, right? Like, right now, 30-year fixed rates are in the high 5s. There's no secondary market for anything else. So if you're an IMB right now, you can't sell arms, they can't do construction, non-QM is challenged. If it's not a government loan or a 30-year fixed rate Fannie Freddie loan, that's all they really have to sell right now, because they're kind of outflanked by the depositories on all the other products. But again, that could change tomorrow. And I don't know what I'm saying, other than this industry, there are climates where it is greatly advantageous to be a loan originator at a depository, and there are climates where it is greatly advantageous to be an originator at an IMB, and you never know what's coming down the pike.
Although, if you haven't built a book of business that is self-sourced, transferable, purchase focused, you can be guaranteed that you are at the whims of market conditions, regardless of where you are. You said something that I was thinking about as I was thinking about talking to you today, and it was, mortgage companies, leaderships, they should be involved in organizations like TMC. There's others, so take your pick, but I personally think TMC is the one, because of the opportunity to engage, collaborate, share with your peers in a very confidential, comfortable environment. Loan officers don't have that. There's been groups that have tried, and it didn't stick. It didn't really work out. But I think about that a lot, because I think loan officer, now look, Todd Duncan does a good job of having events. There's many others, people like Dave Savage, who, has a fantastic tech platform. Dave is a coach at heart. That's just what he is. And people like that will challenge originators to continually do a self-audit, not just an audit of your organization, an audit of your referral partners, but an audit of you. But most don't, Rich, and you know that. It's easier to do what? Try to go get one more loan. because I know the reward that's attached to that loan. I know the commission that's attached to that loan. It's harder to do a self audit and know that that audit on an annual basis or however often you do it is going to create long-term sustainable value. So boy, it sure would be cool if somebody could figure out a co-op, a collaborative for originators. I mean, look, right, the last couple of years, they probably should have had somebody in a room with them say, I'm not telling you not to take the money that's being offered by companies that are providing incredible guarantees, but I am telling you to think about the clawback that you just signed and the promissory provision that ties you to something. Did you really give thought to the long-term implications of this partnership? And if the answer is you did, and you did it for the right reasons, great, high five, go make it happen. But that's just one example, Rich. And I don't know, Thomas and I aren't smart enough to pull that collaborative together, but somebody ought to do it.
Honestly, we've talked about it, like a co-op just for LOs, and there's been like attempts at this, Mastermind and the Todd Duncan and the mortgage market. And, there's a lot of that kind of stuff out there, and I think the challenge in doing that is just, my experience at least has been, like, if we were to start some huge co-op just for LOs, which I agree would have gobs of value for those that would attend and for the companies that would send people, but they get leery to send people to those events because they become LO events of any sort become recruiting opportunities, right? So then as a leader, you're weighing, okay, there would be a benefit in sending these 20 salespeople to Mastermind LO co-op, but my competitors may be there talking to them. So there's a little bit of that. There's some of that. But no, I agree. The idea is very sound because, I've seen a lot of bad decisions made by great loan originators over the years. And I think that part of that is they're on their own little island sometimes. They're fully employees, so they get so hung up on, like, oh my God, where can I make the most money? So
well, and you're right. You'd have to really sit down and consider it. I mean, in my brain, the originator would have to be the one paying for the conference. You can't ask your company to go do it. You're investing in your business. You invest to go to these things. Of course, any environment that puts you around other people that are other companies. I think you've heard me say before in front of groups, I actually hate the word recruiting when it comes to salespeople in the mortgage industry and also in any industry where you're building a book of business that's based upon relationships. Meaning, I trust Rich. I really don't care what company Rich is at. It doesn't matter to me. Wherever Rich is, he's the first person I'm calling when I need to purchase a home or refinance a home. That's it, because I trust Rich. But you put Rich in a room with other originators from 15 other companies, it's going to create a little stress for the company that Rich is with right now. Personally, I don't think that's a bad thing. Your local manager, your regional leadership, your national leadership, do your job. And if you're doing your job, then you will retain them for the right reasons. If you lose them, you weren't a match to begin with. And that's okay. You need to do your job of building relationships. Let's transition for just a second, because I've got a couple questions, then we'll wrap it up. You wrote an article. Actually, you write. I really enjoy your articles. You actually wrote one. Was the beginning of this year, 10 bold predictions for the mortgage industry. Which honestly, Rich, when I first started reading it, I thought you were being serious. So I had to take a breath and realize that this was a satire at some level. If you, by the way, if anybody's listening to this and you haven't read Rich's 10 bold predictions, go read them. I think we need a halftime report, though. I think you need to reevaluate those predictions now that we're halfway through and write another one. There's some fun stuff in there. But you wrote something in 2018, and there was one thing that I noticed that I'd love to talk about for a second, and it was about compensation in the industry. I don't know if you remember this or not. And one of the things you wrote was that sales manager overrides are a thing of the past. And I think what you're saying is they should be a thing of the past. That of course they weren't, and they're still not. The other thing that you wrote was that loan officer compensation is too high. And look, this is just math. I think most of those in the industry would look and say, when you run the numbers, this is a challenge. This is a lever that hasn't been pulled. And when is it going to get pulled? Talk about that a little bit. You know, my philosophy on that is it's going to happen eventually, but the first company to do it is going to have a mass exodus. And so are you willing to deal with the short-term pain before other participants fall in line? Do you still feel the same way? Because things really haven't changed much, Rich, since 2018?
I do feel the same way. And I think you've seen non-producing sales managers be reduced in our industry. You know, it's, and maybe the pandemic years were an anomaly. I know some lenders where they had people, there's just so much money, like, you know, but I'm looking at like today, like that was not real. Like the last 2 years was an artificially fueled just refi insanity. And the amount of refi that was done really ensures us that we're going to have a more normal, historically, mortgage origination market these next few years. So, you know, I think that in general, I think through technology, through other things, you know, lenders you look at a non-producing sales manager, there's a salary, there's override, somebody's got to manage that person, you know, and I think companies there's been a bunch of things, you know, you have attrition in the industry. So ballpark, like the 20% of crappiest LOs that did loans in 2020 are now out of the industry. So you got some of that, makes it a little bit easier. And again, I think just technology and different ways to communicate make it a little bit easier. So I think that's a trend you'll continue to see. And there's a lot of companies out there promoting right now, you know, because again, everybody's looking to differentiate themselves. But I know a lot of companies, including some of our members right now, the hallmark of their kind of recruiting strategy is like, listen, we've reduced all these layers that all these other companies have.
Right.
How it translates to you is better pricing and better compensation. So as far as the LO comp piece, when I wrote that in 2018, I'm trying to think of, we track it in TMC benchmark. It was, I don't know if I quoted what the average LO comp was in that piece. My guess is it was like 110, 111.
I don't think it's quoted in this piece, but I would agree with you. You're probably guessing in the right ballpark.
Last month, it was 92 basis points. This is our work nationally. So it has come down a little.
Yeah.
But again, I don't think companies are going to LOs and saying, listen, we're cutting our comp plan, right? It's bonus money is in there, right? You've got maybe some LOs that were not super productive, but, you know, weighed on expenses and ops staff that are no longer there anymore. So I don't think it's going to come down much more from what it is right now, to be honest with you. And that's especially because, right, companies are recruiting like crazy right now. You're not going to get nobody to come to your company offering lower.
Well, and look, you're recruiting in a market that's right now driven by fear. And so if there's anything that an originator or a group can use as a disqualifier, they're going to look for it and they're going to find it. I mean, we talk a lot about the process of identification, building a relationship, building trust. What happens when you get to the offer stage? Well, you know, rarely am I the smartest person in the room, nor do I want to be. If I am, then somebody should find a better room. But nonetheless, my belief is that if you've reached a point where you're making someone an offer and you can't answer the question of why would they join your company, and the answer can't have anything to do with money. If you don't know the answer, then you have a problem. And then you get into this back and forth about how are we getting to a point where I can show you at the bottom line what you're going to earn based upon the effort and the work that you're doing. No, I really appreciated that article, and clearly things have changed a little bit, but they haven't changed that much, you know, and the industry still needs to grapple with the fact that not only is it an economic issue, in my opinion, but it's also an efficiencies issue. Producing managers make the most sense because it's easier to run those numbers. But the problem is now so look, comp is a product of motivation generally, right? And so if I'm more motivated to do one more loan that I get 115 basis points off versus helping an an originator that I'm getting 10 basis points off of, where does my motivation lie? And by the way, the other thing that I'm not doing is I'm not meeting the people in my market that might be a part of my team eventually down the road because I'm driving one more loan. So that the fix of the producing manager created the problem of the proper motivation to build and maintain a sustainable business in that local market from a branch perspective, or just eliminate all managers and have it just be every originator's on their own, they're running their own business. And look, it's something we're going to keep talking about. I think it's a really fun topic. And I can't wait to see the first company that has the guts to do something dramatically different. Okay, I have one more question, but before I do, anything you want to ask me? I always throw that out there. Anything we didn't talk about before I ask my final question?
Your business has to be just, you guys have to be going crazy right now. I mean, I hear the members talking about you guys, but that's the different part about this climate right now too. If you're recruiting LOs because of your company and a couple others that don't do it as well, that you know everything about an LO when you recruit. I remember recruiting LOs and having them, send me over, fax me over like their production
documentation. That's right.
That were some of them fabricated or homemade reports. And now you know everything. You know how many purchase loans they're closing. You know where they're getting their business. So if you're a leader, because of companies like yours have helped, and that's why, we wanted a partnership with you guys for 2 years before it happened, because that's how we do things. We try to identify the best companies in the business, and we don't want to settle for the crap competitors. And it was because we saw the value in what you guys were doing. I sat in that seat before, so I know the power in being able to say to an LO when you're recruiting them, like, there's no conjecture. There's no, taking their quotes on volume and reducing it by 40%. It's all right there. So lenders have a very firm grasp on this is the value of this person, right? They originated the first 6 months of 2022, 48 purchase loans, and they came from these 16 realtors in these markets. So you guys this has got to be a great time for you guys right now.
It's great. There's always multiple sides to the equation, Rich. I mean, it's never just great. It doesn't work like that. I mean, you know that. You've been through lots of business cycles. My partner and I started a recruiting firm a long time ago. And then we had the idea of taking the best practices that we learned from the companies that we worked with. I mean, we just wake up one morning and think that we know the greatest process ever when it comes to identifying all the way through hiring and retaining originators, branches, wholesale account executives, acquisition opportunities. It happened over time through best practices, through surveys, through getting feedback. But we then took those things and we built a tech stack out of it. Because what we also believe is, look, the recruiters that you can hire through Model Match on the services side, meaning not the software solution. We all live inside of the software solution, but our partners invest in the software solution. And then if they want to add some capacity, we have that capacity if they want to bolt that on. But I will always say this with complete confidence. The best recruiter for your branch, for your region, for your company should be you. It shouldn't be an external. And I think those that work with us on that side are the best. I do think that they're the best, but they're never going to be able to communicate the company value proposition better than the person that should know it backwards and forwards, which is that local leader that's communicating that value proposition to a consumer, to a referral partner, and also potentially to recruits as well. The tech platform was built just to help you be better at your own relationship building activities and to hold you accountable the same way that an LOS holds you accountable to tracking a loan from pre-qual all the way to clear to close, right? The muscle is the same. Now you talk about data. Boy, that was the coolest part of all, right? Because we started identifying, funny story, I'll be quick, but when we first rolled out Model Match, before you and I even really started talking about TMC, long before that, our users came to us and said, we love this, we love the software, but we don't know who to call. And boy, Rich, as a, I don't like to use the word coach, but as someone that can give you some best practices, man, I called BS on that so fast. if you're telling me you don't know who to call, then you're not doing the right things in your local market anyway. You should know who your competition is. Go ask your referral partners who's walking into their office and asking them for business, or who they're giving some business from. But what I learned very quickly was that that's not what you do when you're building a software solution. You look for feature sets that can create efficiencies for your users. So we went and invested in all of that data, and we built Market Insights, which is inside of Model Match, to create what you just said. It's not just validation, it's also efficiencies. You don't need to go spend your time on the 2,000 NMLS IDs in Mecklenburg County. Here's the 25 that meet your criteria. And at a minimum, you can't tell me that you shouldn't make some effort to build a relationship with those people. And you also can't tell me that you don't have the time. It's 25 people. I'm not talking about 3,000. But no, I appreciate your comments and your thought. I get really excited about those things, but I actually get more excited about seeing users and companies just get better at it themselves, because isn't that what tech is supposed to do? Isn't that what best practices is supposed to do? It's supposed to help you do more in less time, but you got to adopt and you got to acclimate. And we play the same game that a lot of other tech platforms play. So, all right, here's my question. You ready for the out the door question?
Let's do it.
Actually, this could open up a rabbit hole that we could go down for a little bit, because you're a sports guy, so am I. Seriously, give me your input on Baker Mayfield. Should the Panthers be happy with this?
For what they gave up, absolutely. It was a steal. It's a 4th or a 5th round pick. We're paying 10 of his $19 million salary. So you get a 1-year rent.
See what happens.
$9 million. You got no commitment to him beyond this year. You got a couple other options with Darnold and Corral. Baker has higher upside. I watched that guy every snap he's taken here in Cleveland and in Oklahoma. And last year he was horrible. I mean, I went last year from being the biggest Baker supporter to he lost me last year.
Yeah.
It was less his play than his action and his antics, just the stink eyes on the sideline and some of the crappy comments and post-game press conferences, the whole drama with Odell at the beginning of the year that ESPN did an insider piece a couple months ago that really went inside that. And basically what it said was Odell Beckham was loved and respected in that locker room. And all the hubbub when that went down about how, Beckham was the problem and his dad posting on social media, it was actually the opposite. Beckham was very highly respected by the locker room and by a lot of the leaders on the team, Myles Garrett, John Johnson, and he lost the leadership of the team during that Beckham thing and then just gassed the fire through his play and his comments through the end of the year. It became an untenable situation. I don't disagree with how the Browns handled it, given what happened last year. But for Carolina, I view it as an absolutely great move. Look at this. The 2 years ago, from week 6 through the playoffs, Baker Mayfield was the 3rd highest rated quarterback.
Saw that.
Through this 14-15 game stretch into the playoffs, tough competition, only behind Mahomes and Rodgers. He was the 3rd best. And a lot of people forget, we played the Chiefs. If Rashard Higgins does not fumble at the goal line going into the half, we probably beat Kansas City and are playing Buffalo the next week to go to the Super Bowl with Baker as the quarterback. So, he's the type of guy that you got to surround him with some talent and some things. But when he's healthy and on his game, he can play.
Well, I'll be curious to see first of all, I'm not a Panthers fan. I happen to sit in Carolina, but I'm a Giants fan, which means that Odell learned his lesson in New York, how not to act, which really disappoints me because he was a generational talent and I didn't want him to leave the Giants, but he acted up in New York, fixed it, and now he's taking it somewhere else. And for Cleveland, for the Rams, I mean, he seems to be a model citizen at this point. But I find the Panthers interesting because, look, Cam Newton had so much talent. I mean, I would never argue with the amount of talent that he has, but he was a locker room destroyer, and he was a sideline destroyer. If you watched his body language we should stop because you and I could do a separate podcast just on this separately. But the Panthers run Steve Smith out of town. There should be a freaking statue of the guy standing outside of the stadium but the open arms, they embraced it. They embraced Cam, who, again, generational talent potentially, but his attitude and his emotion got in the way. I'll be really interested to see if Baker's now figured it out, or else Carolina's right back into this mix where they've got another emotional quarterback that could blow up the locker room.
You know, Baker is so emotional. It really, I mean, to a fault. You know, the other thing is he is incredibly competitive and incredibly angry is the wrong word. He's been proving people wrong his whole life. You know, he was a walk-on at Texas A&M, ended up transferring to Oklahoma, and you know, everybody has said he can't do it no matter where he's been. Well, now he's the #1 pick and there's a lot of expectations. He comes in, has a great rookie year, gets a little too high in his horse, comes into training camp fat, has a horrible second year. Year 3, he's amazing, literally incredible. I mean, people wanted to build statues of him here. Year 4, he's injured. What you're going to get out of Baker, you don't know the health. Assuming he's healthy, you are going to get an insanely motivated and talented quarterback right in the middle of his prime that is playing for literally hundreds of millions of dollars.
Right.
His contract after this year, it could be, depending on how he plays, 2 years, 10 million as a backup, or 6 years, 300 million if he goes out and kills it and shocks the world and takes the Panthers to the NFC Championship game. So he's going to be as motivated as humanly possible, which I think the Panthers see. I can't believe, like, the Seahawks and some of these other teams with garbage quarterbacks, they didn't have to pay nothing to get him.
No, I think from a contract perspective, it was a no-brainer for the Panthers. And to your point, I don't think they have a whole lot to lose at this point. But all right, we'll kill it on that. But what I will say is, anybody listening to this, do not at me on the whole Cam Newton comments. I'm not a Cam. Well, we'll just leave it at that. Plus, I did say I'm a Giants fan. So if you want to blow me up and tell me how horrible the Giants are, I'm not going to argue with you. So anyway, Rich,
Danny Dimes Tom.
You ever want to do a sports podcast, you just let me know, buddy, and we can pull it together.
Let's do it.
All right, Rich, thanks for coming on the Walk Podcast. I appreciate the partnership. I appreciate the friendship. This was a lot of fun, and we'll talk to you soon.
Really appreciate you having me on, Eric. Greatly appreciate the partnership with Model Match. It has been a great one, and yeah, let's do it again soon.
You got it. We'll make it happen. See you, Rich.
Take care, bud.